2024, the business produces and sells a single product branded K, whose details are provided below. So we are given the direct material, which is shillings 5 per unit, the direct labor, which is 10 shillings per unit, the variable overhead 6 shillings per unit, the selling price is 40 shillings. So we are given additional information, projected sales and the production units. Information is provided as follows. So in our case here, we are given the projected sales in units from the month of July all the way to the month of December, all the way to the month of December. These are the units which the company projects it will be able to sell. And then you're given the production. So these are the units which are the company projects it will be able to produce. And then from there, we are given the variable overheads. And the variable overheads are paid in the month that they are incurred. And then you're told the fixed overheads are budgeted at shilling 700,000 per month, which include the depreciation. Remember, we say that depreciation, this one is an non-cash item, So when preparing the cash budget, we don't consider the non-cash item. In other terms, we don't consider those particular items of incomes or expenses which do not give rise to a cash inflow or cash outflow. So in our case, when considering these fixed overheads, we will have to exclude the depreciation simply because it's an non-cash items. And then number 4, we are told wages are paid 75% during the month in which they are incurred or basically earned, that is, and 25% in the following month. Number 5, material costs are paid 2 months in arrears. So in other terms, the material will be paid after 2 months, in arrears. Number 6, a tax liability of 1.4 million to be settled in the month of October. 7, a new van will be purchased in the month of September 2024 for shillings 2 million. And then you're told the current motor vehicle shall be sold in the month of November 2024, and it is expected to fetch shillings 300,000 from a prospective buyer. And then number 8, we are told the cash balances at the month of August 2024 is expected to be 1 million. And specifically, we are told that this is the cash balance at the end of the month of August. Automatically, this cash balance at the end of the month of August shall be the opening balance in the month of what? In the month of September. In the month of September there. And then you're told the business makes a monthly cash sales of 50% of the total sales in a specific month, while the remainder is on the credit, which is settled 1 month after the sales. So what are we required to do? We are required to prepare the cash budget for the month commencing 1st September 2024 to 31st of December 2024. In other terms, you're required to prepare the cash budget for how many months? The month of September, the month of October, November, and December. So that is a cash budget for how many months? For 4 months. For 4 what? Months. So maybe in this case, I don't know whether we have some few workings we need to do here before even we can proceed to prepare our cash budget. Let's see whether we see whether we have some few workings which we need to do before we can proceed to prepare the cash budget. But remember, in this case, we said that the first thing you should even be able to remember is the format of the cash budget. Remember, you said when preparing the cash budget, always we have the details column, and basically columns equal to the number of months. If you can remember the question which we did in class, we prepared the cash budget basically for 12 months from January all the way to December. But in this case, we're required to prepare cash budget just for 4 months. The month of September, October, November, and December. So we need to have basically how many columns? 5. The total, the details column, and basically columns equal to the number of months. And then from there, we start by recording the opening cash balance. We record the cash receipt or the cash inflows. And then after that, we record the cash the cash outflows. So maybe we can see which expenses or maybe which workings we can compute. Now here, we are told this company, which is called 𝐻𝐻𝐶, basically produces and sell a single product, which is called a product K, and we are given the details. So these are basically the production costs. So for the company to be able to produce that product, the company incur direct material cost, direct labor, variable overheads, and the selling price. Maybe in this case, we can have some few workings here. We can have some few workings even before we proceed to prepare what is required. Maybe we can start by computing this particular variable cost, because in this case, I think in point 2, we are told variable overheads are paid in the month they are incurred. Which are the variable costs? The variable costs are basically this cost which we have here, the direct material, direct labor, and the variable overhead. So I think what we need to do is we compute the variable overheads. Let's have that as the first working here. As the first working here, the variable overheads. Or I don't know whether we, instead of having that here, can we have that working within our cash budget? Yes, let's do that. Instead of having separate working, because remember, he said this particular working, for example, in an examination setup, will just be consuming a lot of your time, but basically by the end of the day, they are not marked. So maybe I can have that figure here. The direct material cost is 5 shillings, and then the direct labor cost will be 10 shillings, 10 shillings, and then in this case, the variable overheads will be what? 6 shillings, and then the selling price will be 40. So any working which basically is required, we are going to do it per need basis. We are going to do it per need what basis? Maybe first of all, let's come up with the format of our cash budget. I can basically borrow this one here. I copy. So we are required to prepare the cash budget. We are required to prepare the cash budget here. The cash budget for the month of September all the way to December. So I'll basically be able to copy all these months. I'll copy all these, and then I'll have them here. So I'll basically paste. So those are basically our 4 months, September all the way to December. So what do we start with here? We always start by recording the opening cash balance, Then below that, we record what? The cash receipt. I hope you can be able to remember this. The cash receipt, in other terms, is said that this can also be known as the cash inflows. The cash what? Inflows. The cash which is flowing into the business. Cash flowing into the business. And then down here, I will have the cash payments. Yes, maybe I think that space is enough. I'll have the cash payments. Cash payment. So the cash payment, in other terms, we also refer to this as what? The cash outflows. The cash outflows. Yes, equally in this case, we can also be able to bold this one. Yes. So I think we can go straight to this information which we have in note number 1. Note number 1, we are basically given the projected sales, or the sales, or the units which were expected to be produced and sold. So this one will help us in terms of computing a number of items down here. I think we can start with the note 2. Variable overheads are paid in the month which they are incurred. The variable overhead basically, I've said, are these 3 costs here: the direct material, the direct labor, and the variable overhead. So what I will do, I'll basically copy all these, because these are variable overheads, or the variable costs. So I'll copy all this. I basically bring that here. Remember, once the company pay for some expenses or some overheads, that is a cash payment. I'll basically have that here. I'll paste that here. Okay, so let me redo that afresh. I'll copy Control C, and then I paste it here. Huh? What is happening? What is happening here? Okay, so let me copy. I don't know why this one is not moving. I copy and then I paste it here. Okay, let me copy this one. I see whether it will be able to move. Okay, let me first of all maybe move it to, I arrange this on the right. Because we should be able to move without basically typing. Remember, you see that whenever you're doing these particular questions in an examination setup, you should avoid a lot of typing. A lot of typing will basically be consuming a lot of your time. Maybe I can arrange all these. I arrange this on the right. Let me see whether it will be able now to move. I copy. Yes, it's now moving. So I copy this one. I basically paste it here. Yes. So, but I'll be able to do away with this information about the cost per unit. So what I'll have here is the direct material cost as a variable overheads. Equally here, I'll have the direct labor cost. The direct labor cost. I'll then have the variable overheads. The variable overheads here. Yes. So now having this, I can be able now to proceed and basically compute the variable overheads. I will start with the direct material cost. How do I compute the direct material cost? To compute the direct material cost, I will take the direct material cost per unit, which I'm given up here, which is basically 5 shillings. And then what will I multiply this with? Do I multiply this with the units which were sold or which are budgeted to be sold, or the units which are budgeted to be produced? When computing the variable cost, we base it on which units? Unit to be produced, unit to be sold. Unit to be produced, unit to be sold. We base this on which unit? Yes, this one should basically be based on the units to be produced. On the unit to be produced. Yes, we are going to base this on the unit to be produced. The unit to be produced in September are these ones. So I will enter. Then I'll do the same for the direct labor cost. I'll take the direct labor cost here, and then I basically do what? Multiply that with the unit to be produced, which is 180. And I hope up here I've used, let me see what I've worked with. Yes, I think this one is wrong. This one I need to correct this, because you can see I've used the unit to be sold. I should not use the unit to be sold. I should use the unit to be produced here. Yes. So then the variable overheads in September, I will take the variable overheads per unit here times the units to be produced, these ones. This one. It is also important for you to see what you are told in note number 2. The variable overheads are paid in the month they are incurred. In the month they are incurred. So the direct material cost for September, and also the direct labor cost and variable overheads for September, they were paid in that month. They were paid in that what? Month. They were paid in that a month. Then what I will do, instead of basically repeating all this, I'll be able to apply my formula. But if you check, for example, if I drag my formula here, automatically know it will not work, because what Excel will pick, Excel will be able to pick the value we have here across, and equally it will take this figure across. You can see in these other cells, do we have values here? No. So basically, in computing this cost here, this direct material cost, basically there is something which will not change. This direct material cost per unit, this one will not change. So therefore, I can do this. I can just lock this one. Okay. Even before we do that, can we pick this particular formula, we apply it across, we see whether it will work for us. Is it working for us? No, it is not working for us, because what Excel is picking are these particular units to be produced, but also picking the figures in these cells. So you can see these cells are blank. So what I need to do, basically what we need to do, we need to lock what is not changing. So what is not changing here is this one. This one will not change, but now Excel will be able to pick these others. So I can lock the value in E3. I shift $. Okay, I shift $, and then I shift $, again here, a $. So let me see whether, okay, there is a problem with we have a problem up here. This one should be $, like that. So let me apply that formula. I see whether it will be able to work for me now. Let me apply that. Is it working for us? Yes. We are given values here now. We are given values here. We are given values. So basically, I will confirm how those values have been computed. I'll confirm how those values have been computed. For example, how has this value been computed? We said for you to confirm how that figure has been arrived at, click that cell, highlight that cell, and then you come up here. You come up here. You can see how that figure has been computed. The direct material cost, which is 5, times the unit produced in November. The unit produced in November. Is that correct? Yes, it is very much correct. What about this other one here? How is this figure computed? So I'll come up here. I basically click there. I'll be able to see how that figure has been arrived at. So this one 5 times this one. Is that correct? Yes. So therefore, what we basically need to do from these values which we have here, for us to be able to apply the formula, we need to lock what is not changing. And actually, yes, we have said what is not changing are these values here. So I'll be able to lock the value in E4, shift $, shift $, and basically I'll then be able to do the same here. Shift, I lock the value in E5, shift $, shift $, yes. And then because I have a formula here, I'll basically be able to apply that for the next what? For the next 3 months. For the next what? 3 months. And actually, you have said if you want to confirm how a figure has been computed, highlight that cell where the figure is, and then you'll come up here, come up there. You'll be able to see how the figure has been computed. So, like in computing this variable overheads, we know we take this variable overheads per unit times the units which were produced in November, which is very much correct. Yes. So in our case, we have these are payments which were made in relation to the variable overheads, in relation to the variable overheads. And basically, in our case, we are done with that particular point number. We are done with that particular point number 2. So let's move to point number 3. And point number 3, we are told fixed overheads are budgeted to be sharing 700,000 per month, which include depreciation. So we have the fixed overheads. And I think in this case, are we told when these particular fixed overheads are paid? I think if you check on the information which we have here, the question is silent. If the question is automatically silent, we will assume they are paid in the month they are incurred. Fixed overheads are budgeted to be sharing 700,000, which include depreciation. So what we need to capture here is the fixed overheads. Remember what we said, if you can be able to copy something, better for you, because that will be saving your time. So the fixed overhead, this one we are told will be how much? 700. But these include depreciation. Do we have to include depreciation here? No. So what we will consider as the payment which were made is just 600,000. Just 600,000, excluding depreciation. Why are we excluding depreciation? Because that is a non-cash item. Is a non-cash item. Is a non-cash item. Is a non-cash item. So this basically remain the same for the next 3 months. And okay, remember this one should be 600,000, not 6 million. 600,000, like that. 600,000. So that is a fixed overhead. So we are done with that particular point number 3. Then let's move to point number 4. We are told wages are paid 75% during the month in which they are earned, and 25% in the following what month? In the okay. I think we have made an error in relation to note number 2, because note number 2 specifically was relating to this variable overhead. Yes, I have seen we have made a mistake here. So note number 2 specifically was relating to this variable overhead, because if you come to note number 4, this is referring to wages. Wages are the direct labor cost, these ones. Direct labor cost. And then if you check on what you're told in note number 5, this one is relating to the material. Sorry for that. So I think we need to redo something here. I think what we will undo here, or basically just compute these afresh. So variable height basically is okay. Let's go to note number 4, because here we are told the wages are paid 75% during the month in which they are earned, and 25% in the following month. Yes, I think in this case we need to have some working in relation to the payment of wages. Let's have some working in relation to that. The wages which are paid in each of these months. So I'll have that as a working down here. Workings. So the first workings we need to do here is for the wages paid. The wages paid. Wages paid. And I think here I will need to capture how many months? I will need to capture 5 months starting from August, because we are told wages are paid, 75% are paid in the month which they are earned, 25% in the following month. So it basically means that some of the wages for August were paid in September. So I'll have to capture 5 months, including August. So I'll copy all this. I'll have that down here. So remember, we want to compute the wages paid. The wages paid. Okay, so I need to have the months here again. I'll copy this. I bring it down here. Yes, I paste. Okay. So remember, in our case here, or maybe what we need to do is to compute the wages for each month, and then we will be able to compute the amount paid. Remember, I've said wages. These are the direct labor costs. This is the direct labor cost. The direct labor cost. Because the reason why we refer to this as wages is because you are paid for the time worked, or maybe the units produced. Those are wages. Those are not salaries. The direct labor cost. So let's compute the direct labor cost for each month. Direct labor cost for each month. Now the direct labor costs, this one would be equal to how much for August? For August, I will take the direct labor cost per unit, which basically have up here, and then I'll be able to multiply that with the number of units which were produced in August here. In August. In what? In August. And then once I have that formula, because this one will not change, but these ones will be changing, I can basically lock what it will not change within my formula. What will not change is this one, the direct material cost per unit. So I can lock that one. I can lock that. It is basically from cell E4, cell E4. I can lock that one using the dollar sign like that. So once I've computed that one for September, then what I'll be able to do here, basically to apply my formula across. formula, I'll be able to apply my formula across. We can be able to confirm whether these figures are correct. For example, how has this figure been computed? I highlight that cell, and then I'll come up here. I'll be able to see how the figure has been computed. So you can see what has been used. Unit produced in November, which is basically correct, times what? Times this one, which is basically correct. Now, having that, remember this what the company was supposed to pay, but basically now we want to compute the actual amount which was paid in each month. So we can compute the amount which is paid within 1 month. The amount paid within the same month, within the month, or basically, yes, paid within the month, within the month is how much? Is 75%. The amount which is paid within that month is 75%. And then the remaining 25% will be paid in the following month. Will be paid in the following what? Month. So we compute the wages which are paid after 1 month. After 1 month. After one what? A month. And these are wages equivalent to 25%. 25%. 25%. So here, the wages to be paid in September. Remember, in our case, we're interested with the wages to be paid in September all the way to December. So the amount to be paid here will be equivalent to what? To this one times what? Times 0.75. 0.7 what? 0.75. 0.75. 0.75. How do we make our work a little bit easier here? Because I want us to develop a formula. So maybe you can have 0.75 here, 0.75. So this one will be equal to this one times this. And automatically, what will happen here is that this percentage will not change all the way to December. That percentage will not change. So this one, we can lock it. We can lock what is not changing, which is basically the percentage. We can lock that using the dollar sign, using the dollar sign. Okay, using the dollar sign. The dollar sign. So whatever is not changing, which is basically the rate. So having locked the rate, we can basically apply across like that. So we can be able to confirm, for example, this figure of 1650 should be 75% of that. Let's see. Yes, 75% of what? Of this. Then the remaining 25% will be paid after 1 month. So the amount, or 25%, which will be paid in September, will be the wages for August. So the amount to be paid here, the 25% to be paid here, will be equal to 0.25 times the wages for August, these ones. And equally in this case, what will not change? What will not change is this percentage. This percentage. I can equally come here and I lock it. I lock that percentage here. I lock that percentage here. Yes. So then what we will do, basically, we will apply our formula across like that. And we can be able to confirm whether our computation is correct. For example, we can pick this one. This one, we automatically know it should be 25% of this. I think maybe what we could have done here is to separate this from the amount which are paid, because we're interested in the amount to be paid. So this one should be 25% of this. So let's confirm how this figure has been arrived at. You can see 25% of this. What about this one? This one should be 25% of this. Yes, and basically that is correct. So what we need to do here is now we compute the wages. The wages which are paid. The wages paid in each of the months. The wages paid in September all the way to December. So this one will be equal to this plus this amount here. Yes. So, and basically I'll be able to apply that formula across. I'll be able to apply that formula across like that. So in our case, we already have the wages which were paid. We can basically come here and we say we replace that with the wages paid. Wages paid. And basically, I've said the wages paid, this one is equivalent to the direct labor costs. The direct labor cost. The direct labor cost, which was paid, the direct labor cost. So let's replace this one because those figures are not correct. So we have this for September, and basically we will be able to apply that across. The figures we have down there by default will come up here. So this 1725, 1925, 2150, and 22. So these are basically the wages which were paid by our company for those 4 months, for those 4 months, for those 4 months. Yes, and basically that what we needed to do there. So I think we are done with the wages which were paid. So what we need to do is we proceed to the other item. We proceed to the other item, or basically not to the other item, but rather to the next note. To the next note. So in our case, we are done with this one, the variable files. We are done with this. We are done with the wages, and then materials. Materials here. I think materials, we are told materials are paid 2 months in arrears. Materials will be paid after 2 months. So in this case, whatever we recorded here, this one is not correct. Basically, we need to recompute this afresh. So in this case, the materials which will be paid for in which month? In September, are automatically the materials which were bought 2 months earlier. The materials which were bought in July. How do we compute the cost of material in July? We will take this one, the direct material, the direct material cost per unit, which is 5, and then I'll be able to multiply that with the units which are budgeted to be produced in July, this one. So the materials which were bought in July will be paid after 2 months. They will be paid in September. They will be paid in what? September, like that. So what I need to do basically from my formula which I've developed, I need to log what is not changing. What is not changing is this one, 5. So it is from which cell? Cell E3. I basically need to log that. I need to log that using the $sign like that. Yes. So having logged that one, I'll basically be able to apply my formula across all the way up to December like that. And equally in this case, we can be able to confirm how this figure has been arrived at. So you can see how that figure has been arrived at. The direct material cost per unit 5 times automatically the materials to be bought for to be paid for in December are the ones which were bought 2 months earlier. Materials which were bought in October. So and I think that one is correct. So in our case, we have computed the direct material cost, the wages, the variable, the fixed overheads which were paid. It basically means that we are done with point number 2, point number 3, point number 4, point number 5. Now I need to proceed basically to point number. I need to proceed now to point number 6. In point number 6, we are told a tax liability of 1.4 to be settled in the month of October. So there'll be a tax liability to be paid. This is a payment, a cash payment, a tax paid. This tax of 1.4 will be paid in which month? It will be paid in the month of October, 1.4. 1.4. So no amount to be paid in other months. No amount to be paid in other months. No amount to be paid in other months. We are done with that. We are done with that. Let's move to point number 7. We are told a new van was to be purchased in the month of September 2025. We have a purchase of a new van, So in this van will be purchased in which month? In the month of September, at a cost of what? At a cost of 2 million. Yes, so we are revising on the topic of group accounts. Preferably, I want us to see whether we can be able to revise on 2 areas. One, the area of normal consolidation, and also whether we can be able to revise on piecemeal or the stage acquisition. So therefore, as you confirm, make sure you get the question for December 2024. That is basically the question I want us to start with. December 2024. That is a question I want us to start with. And I hope we didn't tackle that question in class. I hope we didn't tackle that question in class. Is a question for piecemeal, Maybe someone can confirm for me. December 2024. Did we have that question in class? Gilbert? December of 2024. I don't think so. The question number two. Question number two is a question on piecemeal. Yes, did we have that question in class? I don't think we did. We did that question in class. Oh, okay. So if we did that one, then I think we can start with a question which is here. Before I check another one, let's start with this one for normal consolidation. There is a question which I've given as an assignment. The question for December 2022. Let's start with that one. December 2022, question number 3. December 2022, question number 3. Question number 3 is basically a question on the normal consolidation. It's a question on normal consolidation. If you are there, please confirm. I want us to do that question and maybe preferably another one, and preferably another question. Do you have that question with you? If yes, confirm. If yes, confirm. December 2022, question number 3. Question number 3. Yes, the question for H limited, that's the question I want us to do. That is the question I want us to do. Yes. So what are we told in this particular question? The question is, H limited, a public limited entity operating in the information technology sector. It has made several investments in other companies within the industry, which has earned it market leadership in the sector. So the following draft financial statement for the year, which ended 31st of October 2022, relate to H limited and its investment companies. So we're given the statement of profit or loss and other comprehensive income for the year which ended 31st of October 2022 for 3 companies, H, S, and L. Then downstairs we have the statement of financial position for H limited, S, and also L limited. Then from there we have some additional information. Number 1 all the way to note number 7. So then what are we required to do? In part A, we are required to prepare the consolidated statement of profit or loss, another comprehensive income for H group for the year which ended 31st of October 2022. And part B, we are required to prepare the consolidated statement of financial position for H group. Basically, as at 31st of October 2022. Now, remember what we said that once you come across this particular question for group account in an examination setup, we said this particular question, you have to finish it within how many minutes? 40 minutes. So therefore, we said avoid so many workings which are not necessary. The first thing you need to do is always to come up with a group structure. And then from there, you need to come up with a sketch of what you're required to prepare, basically a skeleton of what the examiner is requiring. And then from there, you go through the additional information as you make the necessary consolidation adjustment. And actually what we said is that in working which you are doing, you do it per need basis. Maybe you're computing something like this profit, you adjust it to the group inventory, you adjust it to the group cost of sales. So the first thing we need to do here is we come up with a group structure, we come up with a skeleton of what you're required to prepare. Then later on, we're going to go through the additional information as we make the necessary consolidation adjustments. So let's come up with a group structure. The group structure. Where do we have the information about the group structure? There is some information which are given within paragraph 1, that this information which are given here is for H group. And actually we are told H Limited, this company has invested in other entities. So automatically H Limited is the parent company, whereas now S Limited and L, they are investee companies. So we need to determine whether S and L, are they subsidiaries, are they associates, or basically are they joint ventures? So let's go to the additional information number 1. In the additional information number 1, you're told H Limited acquired 80% ordinary shareholding in S Limited on 1st November 2019, when the retained earnings of S Limited stood at that 340 million. So we're given some information there to help us in terms of coming up with a group structure, and we are told H Limited, this one acquired 80% ordinary shareholding in the company which is called S Limited, on which date? On 1st November 2019. Remember that is the date of acquisition, abbreviated as DOA. So automatically from this will be the parent company, whereas that is the subsidiary. And also in the same point number 1, we are given information about the acquisition of S. We are going to come back to that particular point. Then can we go back? Can we go to note number 2? In note number 2, we are told M Limited is the main competitor of H. So this company, the parent company, has a competitor who is called M. And then you're told on 1st of May 2022, M Limited and H acquired 50% over 200 million ordinary shares of shillings 10 each in L Limited. So basically this company here, that is H, we are told this one acquired 50% of the shares issued by this company, which is called L Limited, whereas now the remaining 50% of the shares were acquired by a competitor. But are we interested with the shares which were acquired by the competitor of H? No. We are only interested with the shares H Limited acquired in who? In L. So basically, if you can be able to remember, we say that if a company or the parent company acquire 50% shareholding and another entity acquire equal shareholding, then we refer to that as a joint arrangement. If you can be able to recall yesterday, we said we have 2 types of joint arrangement, joint venture and joint operation. So therefore, basically by taking on the shareholding, we can say this is a joint venture. But there is still some information which is given within that point. I want us to go through that. But also it is important for us to note or to include the date of acquisition, which is 1st May of 2022. So I've said if we check, we are to go with the shareholding, then we can conclude that this company is a joint venture. But if you check on the information which are given within that point number 2, paragraph 2, we are told the consideration paid by H Limited consisted of cash of shillings 15 per share and also 1-for-2 share exchange when the market price of H Limited shares was shillings 20 each. And then you're told M Limited. M Limited, remember, is basically the company which acquired 50% shareholding here. So M Limited, we are told, paid shillings 15 per share for their interest, but did not issue any shares to the owners of L. So and then you're told the ordinary shares of L have no, or they have 1 voting right each. Then let's go to the last paragraph of note 2. We see what you're told. We're told upon acquisition, H Limited, remember this, in this company here, we have 2 shareholders. We have L, sorry, not L, rather, M Limited, who hold 50%. We have H, who hold 50%. And basically, I've said, if you have to go with the shareholding, then we can make a conclusion that this company is a joint venture as far as H Limited is concerned. But can we check what we are told in that last paragraph? We are told upon acquisition, H Limited had a contractual right to appoint 60% of the board of L. So it basically means that majority of directors in this company, majority of directors in L Limited, that is 60% of the directors of L are appointed by who? Are appointed by H Limited. What does this mean? It basically means that it is H Limited which controls the composition of the board of directors by appointing majority of the directors, 60% of the directors, with the remaining 40% appointed by M. And then you are told M Limited and H, it appointed one member of A Limited senior management team. It is a senior manager appointed by H who makes the key decisions regarding the development of A Limited new strategies, its principal revenue stream, the market it will operate in, and how it is financed. The fair value of A Limited net assets approximated their carrying values at the date of acquisition. What does that mean? It basically means that this company M and H each appoint one member of the senior management of who? Of L. But we are told the senior manager who is appointed by H is the one who makes key decisions. Is the one who makes key decisions in this company here. What does that mean? It basically means that the senior manager appointed by H is the one who controls the financial and operating decisions of who? Of L Limited. Of L what? Limited. Why are we given this information? The reason why we're given this particular information is basically for us to be able to determine whether this company here, that is L Limited, whether it is a joint venture or basically whether it is a subsidiary. In this case, I've said, if we are to check now this shareholding, we will conclude that this is a joint venture. But is it a joint venture? Automatically, no, because you can see two things. H Limited, despite having acquired 50% of the shares, H Limited, number one, controls the composition of the board of directors. Number two, H Limited also controls the operating and financial decisions of who? Of L Limited. And therefore, in this case, we can conclude and we say H Limited here controls L. Controls what? L. And actually, in this case, we say that if the parent company controls another, the company which is being controlled automatically is a subsidiary. Is what? Is a subsidiary. So therefore, this company here is not a joint venture, but basically is what? Is a subsidiary. Why are we making that conclusion? We are making that conclusion as a result of those 2 points. That H Limited appoints majority of the directors. In other terms, it controls the composition of the board of directors of L. And number two, it is a senior manager who is appointed by H who controls the key financial and operating decisions of who? Of R. So therefore, this company here, despite not having acquired majority of the shares, H Limited controls L. And therefore, L here will not be a joint venture, but rather it will be what? It will be a subsidiary. So that was the only trick as far as that particular question is concerned. Majority of the students who did this paper, they basically failed this particular question because what they did, they treated that company as a joint venture. They treated that company as what? As a joint venture. So remember, someone is asking here, Gilbert, what happens to the rate? Now, remember, Gilbert, what we said from in our definition to this topic, the topic of group accounts, we were able to define some terms. Like, first of all, if you can be able to recall, we define what is a group. Number two, we define what is a parent company. If you can be able to remember, you said a parent company, this is a company which controls another. Which controls what? Another company. The company being controlled is what? Is a subsidiary company. And in this case, I was able to explain what you mean by controlling. What we mean by parent company controlling the subsidiary. The parent company controls the subsidiary if the parent company appoint majority of the directors. Appoint majority of the directors of who? Of the subsidiary company. So we have a control. The parent company controls the subsidiary. Number two, if this company basically controls the operating and financial decisions, of another company, then the company whose operating and financial decisions are controlled is known as the subsidiary. So the key word here, whenever we are defining a subsidiary, we take on the control. We take on the control, not specifically the shareholding. Sasa, we take on the control. Does the parent company or the investor appoint majority of the directors in the investee company? Does the parent company control the operating and financial decisions of the investee company? So if that is the case, even if the parent company does not hold majority of the shares between 51 to 100%, the investee company shall be a subsidiary. Shall be what? A subsidiary. So therefore, that's basically what you need to know. And this was basically the trick as far as that question is what is concerned. So once you're able to know that this company was a subsidiary, then the question becomes quite what? Simple. So therefore, if you come across this particular question for group account and you're given such information that the parent company may be acquired like 50% of the shares, but equally you're given this information. It is the parent company which appoints majority of the directors. It is the parent company which controls the operating and financial decisions made by the investee company. Automatically, the parent company has a control. So if it has a control, the company which is controlled is what? Is a subsidiary. Are we together? Is that clear? Is that clear? So if that is clear, then I want us to move. Is that clear? Please. Diana, is that clear? Okay, so I think we will be able to look on how to deal with all those purchase considerations and be able to explain everything there. Okay, so having done a group structure, then we said, can we proceed? We come up with a sketch of what we are required to prepare. Then later on, we go through the additional information, and basically we make the necessary consolidation adjustment. But even before we do that, because you can see, like in part A, we are required to prepare the consolidated statement of profit or loss. It is basically important to check, do we have a company which was acquired during the current year? So in the requirement part A, we are required to prepare the consolidated statement of profit or loss for the year which ended 31st of October 2022. Automatically, the next year will start 1st November. So this year started 1st November of 2021. Do we have any of the company here which was acquired during the current year? So this company was acquired in 2019. It wasn't acquired during the current year. What about this one? This one, you can see it was acquired within the current year. It was acquired on 1st of May 2022. So the reason why it is important for us to be able to determine that is because when preparing the consolidated statement of profit or loss, we are going to take into account the revenue and expenses of L from the date it was acquired. We apportion that on time basis. But for this one, we will take the revenue and expenses for the whole year. We combine with that of the parent. So how many months do we have between these two dates? We refer to that as the date of acquisition, and this one is the date of consolidation, the DOC. So here we have how many months you can compute. We have May, June, July, August, September, October, yes. So 1, 2, 3, 4, 5, 6. So in that case, we have how many months? We have 6. So therefore, when taking into account the revenue and expenses of L, we take that for how many months? For 6 months. So having done, let's come up with a sketch. Let's come up with a sketch. And remember, you say that if, for example, you're doing this within an exam, this is a question you come across in an examination. Coming up with a sketch, we said you should not take more than 15 minutes, such that the remaining 25 minutes should be to deal with the notes, to deal with the notes. So consolidated statement of profit and loss, which is basically for the year which ended 31st of October 2022. 31st of October 2022. 2022. 2022. Yes. So remember here I've said we are preparing this by basically combining similar items of revenue, expenses, those of the parent, those of the subsidiary, basically for the whole year. But for this one, we will take the revenue and expenses just for 6 months. Sasa, yes. In other terms, we will take the revenue and expenses for L4, or basically we will take half, because 6 all over 12 is the same with what? Is the same with half. All items of L, we will take half of those items. So let's go to the statement of profit or loss for individual companies. We have below paragraph 2, because that is the format we use here. And our figures here are in million of shillings. We just need to have one column here. So we will start with the revenue for the parent, which is 8460. And then for the other company, that is S, we take for the whole year, that is 880. And then for the other company, that is L, we are taking half. So we are taking 32 times what? Times 6 all over 12, which is the same with half. And that is what? That is 16. Then what we say is that once you come across these questions for group account, make sure you get this item correct, because we say the only consolidation adjustment which affects this, or which is adjusted here, is any sales between the group companies. So for example, if you are told there was sales between S and H, you come and you list that there. There was sales maybe between H and L. That is the only adjustment affecting what? The group revenue. So then from there, we take the other item, the cost of sales. The cost of sales, we do the same, 40/40 plus 29/10 plus half that of L, which will be 5 what? 5 what? That should be 510. Yes, 510. So then from there, we will get the gross profit. The gross profit. So to the gross profit, we proceed and we less the admin expenses. So for the admin expenses, okay. So before we go to the admin, we have the distribution cost. And also, I hope you can be able to remember, I said in all questions for group account, distribution cost is a free mark. No single time you'll come across a question for group account whereby the distribution cost is having some adjustment. These always have free mark. So we take that of the parent, which is 725, plus that of S, which is 200, plus half that of L, which is 10. This one we can get the final value, because I've said no question for group account will come across whereby this distribution cost is having some adjustment. That will give us a value of 1035. 1035, is that what you're getting? Yes. So then from there we have admin expenses, administrative expenses. We have 1150 plus 350 plus half that of L, which will be 170. Usually we say this one may be adjusted with something like impairment loss on goodwill. We will see. So from there, we will get the profit from operations. So this one we have to compute it. This one we don't add it. Then below that, we have investment income. Investment income, we take that of the parent as 600. Basically, the other companies do not have any investment income. But now what we say is that as far as this investment income of the parent company is concerned, we need to check, was there an investment income generated within the group? For example, we will check whether there were some dividends which were paid by S and also L, because we said if this company paid some dividends, some of the dividends were paid to the parent company. The parent company went ahead to account for that as an investment income. We will check, were there some investment dividends which were paid by the subsidiary companies? And we are going to compute the dividends which were paid to the parent, which the parent accounted as an investment income. We eliminate it there. So then from there, we have the finance cost. The finance cost, mostly this one we said also do not have any adjustment, but we will say for 50 for the parent, 175, and half that of L, which is how much? 160. So then from there, we will get the profit before tax. So to this, we proceed and we less the income tax expense. Now, the income tax expense, we said that this is another free mark. Is another free mark. In any question for group account, no adjustment. No single time you come across a question for group account whereby the income tax is to be adjusted, just like what I've said as far as distribution is concerned. So this is a free mark. So we take that of the parent, 680, plus that of the subsidiary, 80, that is S, and half that of L, which will be 220. So this one we can get the final value. The final value here, the final value, which will be 9 what? 980. 9 what? 80. So then from there we have, we will get the profit for the year. The profit for the year. And then from there we proceed and we add the other comprehensive income, OCI, other comprehensive income. So for the other comprehensive income, we have the gain on property revaluation. On property revaluation. In this case, the company which had a gain is only the parent. So in fact, this one also for the parent will not have any adjustment. We don't have any what? Adjustments. So and then we will get what? The total comprehensive what? Income. The total comprehensive income. That is a sketch. Then as we go through the additional information, we will be able to see which items need to be adjusted here. But I've said, even without having gone to the additional information, there are those 3 marks you should be able to get. So like this one, income tax, distribution. And also I say, in any question for group account, can you make sure you also get this correct? Because in most of the cases, what I say, in terms of how these particular questions are marked, these questions for group accounts are marked. Like in that part, you can see the marks allocated were 8. How do you earn those 8 marks? In most of the cases, is how the question will be marked. That for any correct items you get here, you get 2 marks each. 2 marks for every correct item. Remember, these are the figures which are marked. This one, these final figures here. So it basically means that even without having gone to the additional information, you should be able to get those three ticks. Those 3 ticks, you already have 6 marks with you. Sasa, and also we have said, this one, you should also get it correct. This one will only be adjusted with the sales between these companies within the group. Now, I want us, equally, we have a sketch of what you require to prepare in part B. Then we go to the additional information. We make the necessary adjustments. So the consolidated statement of financial position is at 31st of October 2022. 31st of October 2022. So how do we prepare this one? We basically prepare this one by combining similar items of assets and liabilities, those of the parent company and the 2 subsidiaries. Remember, we said here, when preparing this, even if a subsidiary was acquired during the current year, we don't apportion its assets and liabilities on time basis. Remember, this subsidiary L was acquired 6 months to the end of the year. Do we apportion the assets and liabilities on time basis? No, because this one is prepared as at the end of the year. Never make that mistake of apportioning the assets and liabilities on time basis, even if a subsidiary is acquired some few months to the end of the year. Also, on the other hand, we say, even if the parent company did not acquire 100% shareholding in S and also in L, we take the full amount of assets and liabilities. We don't take, for example, in case of this company, 80% of its assets and liabilities, take the full amount. The same case applies to who? To L. So having that, we can also come up with a sketch here. So we start with the non-current assets. So remember, we just need to have a single column there. And also our figures are in million of shillings, are in million of shillings. So we're going to start with the first item of non-current assets. The first item of non-current assets. And which is that item? Which is that item? Which is that item? The first item here is what? We go back to the individual statement of financial position. The first item is PP. So PP, basically, we are combining for all companies. For all companies. So we have 46, we have 49.40, and then we have 38.20. So then below that, we have investment. And actually, this investment, we are given investment in S, we are given investment in L. That is the purchase consideration paid by the parent company in acquiring shares of S, in acquiring shares of L. Do we include that amount here in the consolidated statement of financial position? No. So what we will do here, we will basically compute the goodwill on acquisition of the two companies, the goodwill on acquisition of S, using that purchase consideration, and then the goodwill on acquisition of who? On acquisition of L. That basically what we recognize here is what? As an asset instead of that. Then below that, I can also see we have equity investment. Equity investment, basically this is the investment in shares, and this equity investment period is by the parent. Is by who? The parent. The other companies do not have any equity investment. And therefore, even without having gone to the additional information, I should be able to remember that there was an investment income here by the parent. Automatically, this investment income by the parent is earned from this equity investment. Is earned from that equity what? Investment. Also, most likely these two items, the investment income and this one, they do not have any adjustment because this is investment in what? In shares. But we need to confirm that. Let's not cross the bracket. Let's leave the bracket open. And then basically from that, we will have the current assets. So current asset, we have inventory. Inventory, we add the inventory for three companies, 2250 plus 2450 plus 1875. Below that, we have the trade receivables. The trade receivables, we have 1980 plus 1710 plus 27. And then below that, we have the cash and cash equivalents, which is 870 plus 600 plus 705. Yes. So then from there, we will get the total assets. The total assets. So then from there, we proceed and record equity. Equity. So we start with ordinary share capital. So for the ordinary share capital, remember, we don't combine the share capital of the parent and that of the subsidiary. So we only include the share capital of the parent. The share capital of the parent, which is 3,000. But mostly we say this one, or always this one will be adjusted whereby you have purchase share exchange consideration. And I can remember in note number 1, actually note number 2, we have share exchange consideration. This will be having an adjustment. Okay, so then from there, we also have, share premium. Share premium, we also include that of the parent. That of the parent, 2,000. So below that, we have revaluation surplus. Revaluation surplus. So the revaluation surplus, we include that of the parent. That of the parent, and something called the parent company share of the post-acquisition share premium of, not the share premium, the parent company share of the post-acquisition revaluation surplus for the other companies. So if you check on the other companies, S and L, you'll be able to see that they do not have any revaluation surplus. So meaning that this item here will not have any adjustment. We don't have any adjustment because we take that of the parent plus the parent company share of the post-acquisition revaluation surplus for the other companies. So automatically the other companies do not have revaluation surplus. So below that we have what? We have retained earnings. Basically retained earnings, we say that this is an item. This is an item you should not basically bother yourself computing. So the computation of this, we said, is a little bit complex. Just ignore that. We say it is not a must you get everything correct here. You get everything correct. So just ignore the retained earnings. So the issue is not balancing. The issue is trying to get maximum what? A max. There is also something which we compute here. which is called non-controlling interest. Equally, we say just ignore that. Just ignore that. Then from there, we proceed, we record non-current what? Liabilities. Under the non-current liabilities, I can see we have long-term borrowing. Long-term borrowing. We said most of these particular items will not be having any adjustment, but we will be able to see we have 44, we have what? 25, and then we have for the other company basically, which is zero, we will see, but most likely this one will not have any adjustment. Then there is something which is below there, that is basically deferred tax. So basically I say that in these questions for group account, whenever you see an item for tax, be it a tax in the income statement, be it a tax here, this one do not have any adjustment. This is another free mark. So that tax, we need to add it, and basically we get the final figure, 1240 plus 920 plus what? Plus 1750. So this is basically a free mark. Just like what I've said as far as this is concerned. Anytime you come across an item for tax, be it income tax, be it deferred tax, be it current tax, in any question for group account, that is always a free mark. A free mark, that is a free mark. So what are you getting here? What are you getting here? I'm given a figure by Gilbert of 3910. Okay. So then finally we have the current liabilities. So for the current liabilities, I have the trade, we have the trade payables, we have 2240 plus 1570 plus 23. So this may be having some adjustments. Then finally, I have current tax. Current tax is also a component of tax, another free mark. We have 2240. No, we have 1250. We have 640. We have 960. So that one you cross the bracket. Any component for tax, any item for tax is free mark. Any item for tax is what? Is free mark. Is a free mark. Is a free mark. Is a free mark for that. So what are you getting here? I'm given a figure for 2850. 28 what? 50. So basically that question, even without having gone to the additional information, is basically a question you should be able to pick a number of marks. So like equally, you can see how many entries do we have here? Like we have these 2, 3. So if, for example, you're to be given 2 marks for each correct entry, because the marks allocated there were 12, it means that you need to get 6 items correct here. For each item, you get 2 marks. So it basically means that we have that, and that. You already have 6 marks here. So you have 6, we have 6 marks there. So that question, if, for example, you decide to leave it at that point, we have not gone even to the additional information. That question we already have how many marks? 12 marks. So therefore, we say, as far as this question for group account are concerned, can you be able to remember those particular areas whereby you get free marks? Sasa, yes, now having this, I want us to go through the additional information as we make the necessary adjustment. But basically what we said is that even before you sit for this paper in next week, but 1, make sure you can be able to deal with this. You remember, number 1, how to compute the goodwill. How to compute the goodwill using the full goodwill method and also using the partial goodwill method. Using the full goodwill method and also the partial goodwill method, the partial goodwill method. Janet, you should be able to see my entire board. Just double click your screen if you're using your phone. Double click your screen. You should be able to see the entire board. Or there is part of the board which is not. I can even be able to see this part here for 8. Double tap your screen. Double tap your screen. Should be able to see the entire board. Should be able to see the entire board. So in this case, what I'm saying, even before you sit for this paper, make sure, number 1, you know how to compute the goodwill using the full goodwill method and also using what? The partial goodwill method. And also you're in a position to deal with to make adjustment, to make this consolidation adjustment. Number one, adjustment relating to unleased profit, adjustment relating to what? To amount of intercompany debt, which is equal and which is not equal. And also you're able to do adjustment for fair value adjustment. If the subsidiary company valued the assets on the date of acquisition, do you know how to determine the revaluation gain and how to compute the depreciation other charge? And also the other adjustments. But we say these are like the key: unleased profit, intercompany debt, and the fair value adjustment. Let's go through the additional information we see what you're told, specifically in note number 1. In note number 1, you're told H Limited, which is basically this particular subsidiary, this parent company, that is, acquired 80% ordinary shareholding in S on 1st November 2019, when the retained earnings of S was 340. This is now the pre-acquisition retained earnings. So that one is used in the computation of goodwill. And then you're told the acquisition consideration consisted of cash of 1830. So that cash consideration is within the balance sheet of the parent. I hope you can remember in the balance sheet of the parent, under the non-current assets, we are given the amount invested in S, which is 1830. That is the cash consideration. And then you're told the fair value of the identifiable net asset of S at the date of acquisition was 2440. So in our case, we are given the fair value of S Limited net asset on the date of acquisition, 2440. And then you're told the excess of the excess fair value over the carrying amount was due to unrecognized Brad, whose remaining economic useful life at the date of acquisition was 5 years. So I think in that case, we need to compute the value for that unrecognized Brad. And I hope you can also be able to recall, we did 2 questions for group account, and I think we were given, we came across a note that the subsidiary company on the date of acquisition revalued a Brad. Basically, we said a Brad which is revalued, that one should be recognized here as a non-current asset. And recognized a Brad, and recognized Brad. Are we given the value for that Brad? No. But basically what we are given the fair value of net asset on the date of acquisition. And basically we know how we compute this. This one we computed by taking the ordinary share capital of S plus the pre-acquisition reserves. The pre-acquisition reserves. That is basically how we compute the fair value of subsidiary company net asset on the date of acquisition. So in our case, we have this. We have the fair value of the net asset, which is given as 2440. So this one should be equal to what? Should be equal to the ordinary share capital of S plus the pre-acquisition reserves. Pre-acquisition reserves. Automatically what we said is that this particular Brad which was revalued, one is recognized as an asset. So, and then we credit an account called the revaluation reserve. So automatically in our case, we are not given the value for that reserve. Yes, but basically, once we take into account the values which are given here, the ordinary share capital for this, because we have it. So there is now that reserve, revaluation reserve, which occurred on the revaluation of this Brad. That is not what, that is the value which is not given here. But basically what we know, can we go to the balance sheet of this company, specifically in the equity section? I want us to check the ordinary share capital of S. What is the ordinary share capital of S? A number of things. We started by doing a recap on what we had covered in a PAR, basically how to do the normal consolidation, how to prepare the group accounts, basically whereby the parent company has invested in a subsidiary, associate, or basically joint venture. And we're able to look on a question, I think, which was there last sitting, the question for April 2025. We also did something to do with the piecemeal or the stage acquisition, where we said that this whereby the parent company has acquired the control or acquires control in the subsidiary through several purchase of shares. Equally, we did a question as far as that is concerned. In our previous class, we looked on how to prepare the group account, whereby we have a disposal of interest. And actually, we say disposal of interest is whereby the parent company has sold some of the shares, or basically all the shares which are held in a subsidiary. So I think we did a question on partial disposal, but because of time, we are going to do another question on that, but not now. During our revision, we're going to do a question on full disposal, because in terms of how we prepare the group accounts, whereby we have a full disposal, I hope you can be able to recall what we said. We account for a subsidiary which has been fully disposed as a discontinued operation. We have to compute its profit or loss before it was disposed, and also the profit or loss arising from the disposal. And actually, we said that one should be recognized as a separate item within the consolidated statement of financial position. So during our revision, automatically we're going to do a question on full disposal. So make sure you remind me on the same during our revision. So today I want us to basically proceed, and we look on this. I think should be the last concept before we look on the group cash flow. I want us to look on what is known as the overseas. In other terms, we refer to this as a foreign subsidiary. A foreign subsidiary. And in this case, the standard which is applicable here is International Accounting Standard number 21, IAS 21, overseas, or basically a foreign subsidiary. So first of all, we need to ask ourselves here, what is an overseas, or basically at the end of what? Of the year. So if you're able basically to know that, then this particular question, or the question for preparation of group accounts whereby we have a foreign subsidiary, they become very, very simple. But it is obvious that in the process of translating the assets, liabilities, revenue, and expenses of this foreign subsidiary into a presentation currency, there is something which is known as the translation, or basically, yes, the translation currency difference, or can we just refer to it as the exchange difference? Exchange difference. In other terms, we refer to this as the currency translation difference. Translation difference. Currency translation difference is basically an exchange difference which arises from translating the items of asset, liabilities, revenue, and expenses of this foreign subsidiary into presentation currency, of which in this case we are going to see this currency translation difference, or this exchange difference, can either be a gain or basically a loss. Can either be a gain or a loss. Now, this particular gain or loss, we can say this arises due to translation. This arises due to translation of basically three items. One of which is goodwill. Is goodwill on acquisition. Number two is a profit for the year. And number three, the subsidiary company opening net assets. So opening net assets. Opening net what? Assets. So we are saying that this currency translation difference, which arises as a result of translating the items of asset, liabilities, revenue, and expenses into presentation currency, it basically arises from the translation of those three items. So I want us to look on how we determine this currency translation difference, which basically arises from translation of those three items. The goodwill, profit for the year, and the opening net assets of the subsidiary. So let's start with the goodwill. So remember, goodwill, this is the difference between the purchase consideration paid by the parent company and the net assets which were acquired. So basically, what is important, first of all, to note here is that when computing the goodwill, first of all, we compute the goodwill, or basically we say that goodwill is computed using the fractional currency. The fractional, remember, is the local currency. For example, the local currency of Kenya is Kenyan shillings. The local currency of Rwanda is Rwandan franc. So first of all, we compute the goodwill using the goodwill is computed using the fractional, or the local currency of the foreign subsidiary of the foreign subsidiary. So if the foreign subsidiary is operating in Rwanda, what you do when computing the goodwill, first of all, compute the goodwill in Rwandan franc. You compute the goodwill in Rwandan franc, not in Kenyan shillings. Compute that using Rwandan franc, and then translate it, translate it into presentation currency. Translate that into presentation currency. So compute that goodwill using the functional or the local currency of the foreign subsidiary, then translate that into presentation currency. In the process of doing that, we have an exchange difference. How do we compute that exchange difference? I want us to look on how we compute the exchange difference arising from the translation of goodwill, goodwill. So basically, for us to be able to look on how we determine this, we need to have like a number of columns here. So here we have, in this case, I will assume our parent company operates in Kenya, but the foreign subsidiary operates in what? In Rwanda. So here we will have now the local currency of the foreign subsidiary, assuming it is Rwandan franc. This is basically the local currency of the foreign subsidiary. We have a column here for the rate of exchange. The rate of exchange, you'll be given the exchange rate between Kenyan shillings and the Rwandan franc. So here we have a column for the exchange rate, and then here we translate that into presentation currency, which is the Kenyan shilling. So here we always start with the goodwill on acquisition. The goodwill at the date of acquisition, you'll be able to see in all these particular questions for foreign subsidiary, this particular foreign subsidiary is always acquired at the start of the current year. So therefore, what we do, we compute this goodwill on the date of acquisition, which is always at the start of the current year. And I've said we compute this goodwill always using the functional or the local currency of the foreign subsidiary. So if the subsidiary is operating in Rwanda, we will compute that goodwill using the Rwandan franc, this one. Then we translate that into Kenyan shillings using which exchange rate? The opening, O for opening, the opening exchange rate, the exchange rate at the start of the year. We get the value there. And then out to this, what we do is that we less any impairment loss. This particular goodwill automatically will have impaired. So we less impairment loss here. And because this impairment loss is an expense, you have to remember what you have said here. Any item of income or any item of expense will be translated using which rate? Which rate? The average, A for average. Maybe you can just note that somewhere, A for average. And then we get now the impairment loss in what? In Kenyan shillings. So then we take this minus that, and basically you read one line here, that now will give us the value for goodwill at the end of the year. This will be the value of goodwill at the end of the year, and that is the date we are doing our consolidation. Remember, doc is the date of consolidation. So this will be the value for the goodwill at the date of consolidation, which will be at the end of the year. Then we take this particular goodwill, we translate it now into presentation currency. And in this case here, because it's an item of assets, and we are translating that at the end of the year, now we have to use which exchange rate? We use the closing exchange rate. We take this, we translate it into presentation currency using the closing exchange rate. We get the value there. Then for us to be able now to compute this exchange difference, what we do is that we compare the value which we will have gotten here, this one with this one. So we compare these two values here. We compare these two values, this and this, of which in this case we can have an increase. Maybe from this to this, we can have an increase. Or basically from this to this, we can have what? A decrease. We can have a decrease. So that increase or decrease is what you refer as exchange difference. And this exchange difference can either be an exchange gain or an exchange loss. So if basically we have an increase, maybe from here we have 80 million, but here we have 100 million, you can see we have an increase. An increase is a gain. The value for goodwill increased is a gain. An increase is a gain. But if we have a decrease like 80 million to 60 million, that is a decrease. A decrease is basically what? An exchange loss. An exchange loss. An exchange loss. Now, this particular exchange gain or loss, this exchange gain or loss, this one will be recognized in the consolidated income statement. In the consolidated income statement as part of other comprehensive incomes. Will be recognized in the consolidated income statement as part of other comprehensive incomes, part of other comprehensive incomes. So we know other comprehensive incomes, we add this to the gross profit. Not to the gross profit, sorry, we add this to the profit for the year. To the profit for what? For the year. So that's basically how we compute the exchange difference or the currency translation difference, which arises from the translation of what? Of goodwill. Translation of a goodwill. So then from there, once we look on how we compute the exchange difference arising from translation of these two items. So the exchange difference arising from the translation of these two items, profit for the year of the subsidiary, opening net asset of the subsidiary. This one is computed. We compute the exchange difference together here for those two items. The exchange difference on translation of those two items. So here we need to have the same columns. The local currency of the foreign subsidiary, the exchange rate, and the presentation currency. So always here we start with the opening net asset. The opening net asset. These, in other terms, are the net asset of the subsidiary on the date it was acquired. Remember, we have said in all these questions for foreign subsidiary, foreign subsidiary will have been acquired at the start of the year. So take the opening net asset. The opening net asset on the date of acquisition in in local currency, for example, rand and franc. Translate that into Kenyan shillings using the opening exchange rate. You get the value here. And then to this, you add the profit for the year. The profit for the year. And remember, this is the profit for the year for the subsidiary. In case there is some adjustment affecting or which should be affected in the income statement of the subsidiary, like a depreciation, other charge, maybe something like amortization, which was not accounted for by the foreign subsidiary as a result of fair value adjustment. Remember, we said whenever the subsidiary has been acquired, the subsidiary can devalue assets, like maybe item of PP or even things like intangible assets, like maybe brand or something like that. So if that the foreign subsidiary devalued some assets, automatically it's never accounted for that. So if it is an item of PP, you have to compute the depreciation at the charge. You are adjusted to this profit. If maybe it revalued an intangible asset like brand, compute the amortization adjusted to this. So you have the adjusted profit for the year. And because these are profit, you translate it into this into presentation currency using which exchange rate? Using the average exchange rate. Using the average exchange rate. The average exchange what? The average exchange rate. And then basically what we do down here, you leave two lines there. What we will have here is the crossing net assets. The crossing net asset of the subsidiary. We translate that now into presentation currency using the crossing exchange rate. Using the crossing exchange rate, we get now the translated value here. And then we take this plus this, and basically we compare these two. We compare this with that, just like what we have done down here. So the difference which you get here is what is known as the exchange difference, or actually this one would be the exchange gain, or the exchange what? Loss. So if from this to this, remember this net assets. So just like goodwill. So if from this to this we have an increase, is an exchange gain. If we have a decrease, is an exchange what? Is an exchange loss. Is an exchange loss. And equally now this one will be recognized within the consolidated statement of profit or loss, or the consolidated income statement as part of other comprehensive what? Other comprehensive incomes will be recognized there as part of the other comprehensive incomes. So basically this is how we compute the exchange difference. That is the exchange gain or loss arising from the translation of the various items of assets, liabilities, revenue, and expenses of the foreign subsidiary, of the foreign what? Subsidiary. So once you come across this particular question for foreign subsidiary, usually maybe in Roman 1 of the question, the examiner will require to compute this. the exchange difference or the currency translation difference arising from the translation of goodwill and also the profit for the year and the opening net asset. That's basically how you do that computation. Roman 2, then you'll be Roman 2, Roman 3, you'll be required to prepare consolidated income statement, consolidated statement of financial position. I'll say for you to prepare number 1, the consolidated income statement. So before you even, or basically when combining the revenue and expenses of the parent and that of the subsidiary, you'll take that of the parent, which is already in presentation currency, but you have to translate that of the subsidiary. We have said that all these items of the subsidiary will be translated using the average. All items of the income statement will be translated using the average exchange rate. But the items of assets and liabilities, those of the foreign subsidiary, will be translated using the crossing exchange rate. Crossing exchange rate. So if you can be able to recall that, basically this one is quite simple. Quite simple. And I think with that particular knowledge, I want us to go straight to a question. We go straight to a question on a foreign subsidiary. On foreign subsidiary. Usually, this is one of the areas which is very simple. You'll be able to do that. You'll be able to see that. One of the areas which is very simple. Very simple. Yes. I want us to do a question with both the income statement and the statement of financial position. And basically the question I want us to start with. Yes, so let's start with this one. April 2022. April 2022. Which is the question number 1. Question number one. April 2022. So if you're there, you can just confirm. Yes, are you there? Are you there? Okay. So what are we told here? What are we told? What are we told here? We're told that P Limited is a public limited company listed in the securities exchange. Listed in the securities exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Both companies prepare their financial statements in accordance with international financial reporting standards. The presentation currency of the group is Kenyan shillings, while S Limited functional currency is franc. Remember, I've explained what is the meaning of those two currencies. Presentation currency is the currency used by the parent company to prepare the group accounts. We are told is Kenyan shillings. But now, this foreign subsidiary, which is S Limited, it operates, we are told, is domiciled in a foreign country. Its functional currency, the local currency of that foreign country is franc, which is denoted by FR. And then you're told the draft financial statement for the year, which ended 31st of December 2021, and set out below. So we're given the statement of profit or loss for the parent and that for S. You can see the statement of profit or loss for the parent company is in Kenyan shillings, but that of the foreign subsidiary is in franc. That's why I say, if, for example, now you're preparing the consolidated statement of financial position, there is no way you can do direct translation. Sorry, direct consolidation. That is direct consolidation. You take the revenue and expenses of the parent, you add with that of the subsidiary. You can't do that because you can see those statement of profit or loss of the parent, that of the subsidiary are in different currency. That's why we are saying even before you do the translation, we translate those items of the foreign subsidiary into presentation currency, which is Kenyan shillings. So then from there, we have the statement of financial position for the two companies, P and S. Equally, you can see the statement of financial position of the parent is in Kenyan shillings, that of the foreign subsidiary is in franc. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 5. What are we required to do here? We are required to determine the exchange difference, which is basically the gain or loss arising from the retranslation, or basically arising from the translation of the net asset and the goodwill on acquisition of the foreign subsidiary. Part B, we are required to prepare the consolidated statement of profit or loss and other comprehensive income for the year which ended 31st of December 2021. And then from there, we are required to prepare the consolidated statement of financial position. So before we even do that, I want us, we come up with a group structure. Let's come up with a group structure. Group structure. And the group structure. So where do we have information about the group structure? We have that information in note number 1. Let's go to note number 1. In note number 1, you're told on 1st of January 2021, the company which is called P Limited acquired 80% of S Limited, 1 million, 1 franc ordinary shares for a cash consideration of 35.50 million franc. So this company acquired S Limited, and basically this S Limited, remember, we are told is domiciled in a foreign country. Is domiciled in a foreign country. Is domiciled in a foreign country. In other terms, is a foreign subsidiary. In other terms, is a foreign subsidiary. Yes. So in this case, we have the parent company and basically the foreign subsidiary. As per that note, we are told the acquisition took place on 1st of January 2021. So that is the date of acquisition. Remember, I said in all these particular questions for foreign subsidiary, usually the subsidiary is acquired exactly at the start. So it was acquired on 1st January 2021. That is the date of acquisition. When are we required to prepare the group account? The date of consolidation doc. So in the requirement, specifically in Roman Part B and Part C, we're required to prepare the group account for the year which ended 31st of December 2021. You can see our subsidiary was acquired exactly at the start of the year. Sasa, yes, we say it's always important for you to note the date of acquisition. So we have that information there. That is the group structure. P is the parent, S is a foreign subsidiary. Now, in that case, we are given the purchase consideration which was paid, which was 35.50, and actually this is in franc. Then no working which is required there, but we are going to use that information in computation of goodwill. In Part B, also not Part B, rather note 2, we are told at the acquisition date, the carrying value of S Limited net asset was 2,600 million franc, but the fair value was 3,200 million. In other terms, this company revalued the assets. On the date of acquisition, revalued its net asset. We are told the net asset had a fair value of 3,200 million franc, and the carrying amount of this net asset was 2,600 million. So it basically means that in this case, we have an increase in the value of the asset by 600, which automatically is a revaluation what? Gain, is a revaluation gain. So, and then you're told the excess in the fair value of the carrying amount was due to unrecognized branch with a remaining useful life of 5 years at the date of acquisition. So we are told this revaluation gain is due to a brand. In this case, a brand is basically a form of a brand is a form of a trademark. In other terms, a brand, this one, this is a form of an intangible asset. This is a form of an intangible asset. Just like the other question we did, whereby we were told that the subsidiary on the date of acquisition valued or basically there was a list of customers which was not yet recognized. And we say that list of customers should be recognized as what? As an intangible asset. The same case with this particular brand. So what is the value for the brand? So the unrecognized brand. Unrecognized brand. And basically we are saying that this unrecognized brand, this is a form of an intangible asset. A form of an intangible asset. So the value for this brand would be the difference here. It will be equal to 200 million franc minus 26. This will be 600, or this will be 600 million franc. Remember, this particular asset here was revalued on the date of acquisition. So how are we going to account for this amount here? This amount of 600. So this amount of 600, number one, this one will be recognized as an intangible asset, within the consolidated statement of financial position. Is an intangible asset. Number two, this one is a pre-acquisition revaluation reserve. Is a pre-acquisition revaluation what? Reserve. So that's the first thing you need to know. And then in the same point, we are told that this particular brand had a remaining economic useful life for 5 years at the date of acquisition. Remember, I think in most of the questions which you have done, we were told the item which was revalued was an item of PP. What we were doing, we were computing the depreciation at the charge. In this case, do we depreciate intangible assets? No, we amortize. So what we need to do here is basically we compute the amortization, because what we say is that once the subsidiary company has revalued the asset, the subsidiary company do not account for that revaluation. So what we need to do is to compute the amortization for this brand. The amortization, we compute this using the same formula we were using to compute the depreciation at the charge. We take the revaluation gain for the value at which the asset was revalued at. We divide that with the remaining useful life or economic life. And I think we are told the remaining economic or useful life in note number 2 were 5 years. 5 years, we divide that with 5. And then we should multiply that with the proportion of time. The proportion of time is the time we have between these two dates. In this case, we have 1 year. So we are interested with amortization for just 1 year. For just 1 year. So this will give us what? This will give us 120 million. And it is also important for you to note that this 120 million, this is still in franc. This is in foreign subsidiary. This is in foreign what? Subsidiary. So this one, this amortization, number one, this one is basically an expense. It's an expense within the consolidated income statement. And number two, this one will be deducted from this. So this one will be deducted from intangible assets. So the value for intangible asset would be 600 minus this one, which is basically 120. So I think we are done with that. Let's move to the other point. So let's move to the other point. So in point number 3, we are told the non-controlling interest in 𝐻 Limited as at the date of acquisition was fair valued at 1450 million franc using the fair value model or the fair value method. So it basically means that in computation of goodwill, we are going to use the full goodwill method. That's why we are given the NCI at fair value. So, and then number 4, we are told as at 31st of December 2021, that is at the end of the year, it was determined that the goodwill arising on acquisition of S was impaired by 10%. That is the impairment loss. Okay. So number 5, we are given the exchange rate. We are told the foreign exchange rate are relevant. So what you must be in a position to do is to interpret those exchange rates. For example, we are given the exchange rate on how many days? We are given 3 exchange rates. On first, at the start of the year, which is the opening, we are also given the closing exchange rate, and then you are given the average. You're given what? The average. So how do we interpret that? For example, the exchange rate here at the start of the year. So it is given up there, you can see franc to 1 Kenyan shilling. Franc to 1 Kenyan shillings, and the opening is 5. So this means that the opening exchange rate is 5 franc. 5 franc, this one is equal to 1 Kenyan shillings. Sasa, yes, that's basically the interpretation of that. That 5 franc is equal to 1 what? Kenyan shillings. Sasa, yes. So that's basically what we have. And I think now having that information, we can just go straight to answering our question. Let's just we go direct to answering our question. But I think before we do that, we start, basically we're going to start with Roman 1. I think the first thing we need to do is let's compute the goodwill arising from acquisition. And remember you said we compute the goodwill arising from acquisition of this subsidiary using the foreign currency. The foreign currency of 𝐻𝐶 Limited is franc. We compute that goodwill using franc, and then we are going to translate it into Kenyan shilling. In the process of doing that, we are going to determine the exchange gain or loss as required in Roman 1. So let's do that, and basically that will be part of the workings, and then we will be able to use that goodwill to compute the exchange difference. So remember, in this case, the method we are going to use is the full goodwill method. The full goodwill method. So at the full goodwill method, here we just need to have, let's just have one column. We are computing this in franc. In franc, the foreign currency, the franc, and the figures are given in million of shillings. So goodwill using the full goodwill method, or we compute the goodwill using the full goodwill method by, number one, taking the purchase consideration which was paid by the parent company. To this, we add the NCI at fair value. At fair value. Remember, we are computing this using the foreign currency, the local currency, which is franc. So this purchase consideration, which was paid by the parent company, that one is within note number one. Note number one, which is given in franc, and that is 35.50. 35.50. So we also have this one, NCI at fair value, in note number 3. Note number 3. So the NCI in 𝐻𝐶 Limited at the date of acquisition was valued at 14.50 million franc. So we add these two values. What do we get? What are we going to get here? Is it 6,000? 6,000 franc? What are we going to get there? Purchase consideration paid by the parent, note 1, 35.50, plus the NCI at fair value in note number 3, 14.50. That will give us 5,000. That will give us 5,000. 5,000. So then to this, we proceed and we less the fair value of net assets acquired. So in our case, we know at the date the subsidiary company was acquired, the fair value of its net asset, as per the information we have in note number 2, the fair value of its net asset is already given. This one, it was 200 million franc. That is still in franc. Now, take into account we are using the full goodwill method. We will take 100% of this. We are using a full goodwill method. We take 100% of that. So the goodwill arising from acquisition. The goodwill arising from acquisition is how much? Goodwill arising from acquisition is how much? Is the goodwill arising from acquisition is 1,800 million. 1,800 million. It's also important for you to note that this is in foreign currency. This one is in franc. Now, having that, I think we can just go straight to part A of that question. Part A. And basically, we are required to compute the exchange difference. The exchange what? The exchange difference, which is basically a gain or a loss, on translation of two items, net asset and goodwill. So we're going to start by computing the exchange difference on translation of goodwill. On translation of goodwill. Translation of goodwill. So this one is very, very simple, very, very simple, provided you can be able to remember the format which I've given you for computing this. If you can be able to remember that format, this one is quite simple. So in this case, we need to have various columns here. The first column here will be for the foreign, the local currency of the foreign subsidiary, which is franc. We have the exchange rate, and then we are translating that to Kenyan shillings. And our figures are in million of shillings. Are in million of shillings like that. So what we start with here, we start with the goodwill on the date of acquisition. The goodwill on the date of acquisition. So the goodwill on the date of acquisition is this one, that is 1800. 1800. So we translate this into Kenyan shillings using which exchange rate? Which exchange rate do we use here? Remember, this is the goodwill on the date of acquisition, 1st January 2021. Is that the case? So we translate this using the opening exchange rate. The opening exchange rate as per note number 5 is 5. And basically that is 5 franc, which is equal to 1 Kenyan shillings. So how do we translate this into Kenyan shillings? Remember, this is franc. This is 1800 million, sorry, 1800 million franc. We want to translate that into Kenyan shillings like that. So basically we need to cross multiply, then we divide. So we take 18 times 1 into divided by 5. In other terms, what is important for you to note here, when translating, in translating franc into Kenyan shillings, you'll take the figure which is in franc, you divide that with the exchange rate. Like in this case, 1800 is in franc. To translate that into Kenyan shillings, you divide that with the exchange rate. If you know that now, it becomes much simpler. Sasa? Yes, because you'll be taking all the figures in franc to divide to translate them into Kenyan shillings. You divide that with the respective exchange rate. So we will divide that with 500. So we take this divided by 5, not 500, sorry, by 5. That will give us what? That will give us what? We try to hurry up. We try to hurry up. So that one will give us 360. That one will give us 360. And then out to this, we have said we need to less the impairment loss. The impairment loss. So the impairment loss, we are given that information in note number 4. Note 4, we are told as at 31st of December 2021, it was determined that the goodwill on acquisition of S was 10% impaired. So this goodwill was 10% impaired. 10% of this is 180. 180. So first of all, we need, this is an item of expense. Being an item of expense, we will translate that into Kenyan shillings using the average exchange rate. The average exchange rate as per note number 5 is what? Is 4. Is 4. Is 4. So we take this divided by 4. What do we get? 180 divided by 4. That will give us what? That will give us 45. 45. Then what we do, we take, remember this one should reduce the value for goodwill. Eh? So what you do, you leave 2 lines there. And then we will have the value for goodwill at the end of the year. That is on 31st of December 2021. So this minus that. That basically that will give us what? 1800 minus 180. That one will give us 1620. So that is the value for goodwill at the end of the year in foreign currency, in functional currency. Sasa? Yes. Now, before we proceed to determine the exchange difference, which is a gain or a loss, first of all, get the difference between these two values. Write that value here. Write that value there. Oh, sorry. So this one should be 6. The average is 6, not 4. The average is 6. Yes, thank you for that. The average is 6, not 4. The average is 6. So this one would be 30. That one would be 30. Is that the case? Yes, 180 divided by 6 is 30. Is 30. The average is 6. Yes. So we get the difference between this, which will give us 330. 330 equally, ensure you have a line here. Then what we do, we translate this goodwill at the end of the year into Kenyan shillings using the crossing exchange rate. The crossing exchange rate is what? Is 4. So we take this divided by 4, and that now will give us the value for goodwill at the end of the year in Kenyan shillings divided by 4. That will give us what? 405. Now then we compare these two values here. We compare those two values there. We determine we have an increase or a decrease from 330 to 405. What is that? That one is automatically an increase. is automatically an increase. An increase of what? An increase of 75. So being an increase, we refer to that as the exchange gain. As the exchange what? Gain. And basically, I'll say that this one within our consolidated statement of profit or loss is part of other comprehensive income. Is part of other comprehensive income. So basically, that's how we compute the translation or the exchange difference, which is the exchange gain or loss arising from translation of goodwill. Arising from translation of goodwill. So then, still in Roman 1, we need to compute the exchange difference, which is gain or loss, which arises on translation of net assets. Translation of net what? Asset. Translation of net assets. Translation of net assets. So we need to have the same format here. The local currency or the functional currency of the foreign subsidiary, the rate, and the presentation currency, which is Kenyan shillings. So here we start with the opening net assets. So the opening net assets is what we have here. So we know that at the date the subsidiary was acquired, it revalued its net assets, and the net asset of the foreign subsidiary had a value of what? 32. So that is the opening net asset. The opening net asset of the foreign subsidiary. So we need to translate that into Kenyan shillings using the opening exchange rate. The opening exchange rate is 5. This one. The opening exchange rate. The opening exchange rate. That will give us what? 32 divided by 5. So which will give us what? 6. I'm getting 640. Are you getting 640? Yes, 640. Then to this we have said we add the adjusted profit for the year. The profit for the year of the foreign subsidiary. And basically that one should be the adjusted one. The adjusted one. So let's go to the income statement of S Limited, which is a foreign subsidiary. From the income statement of S, how much was its profit for the year? Its profit for the year is 1,500. Is 1,500. 1,500. I hope you can be able to see that. From the income statement of S, its profit for the year is that 1,500. 1,500. Yes. Now I'll say you need to check whether this foreign subsidiary that is S, whether it had something like depreciation under charge, depreciation overcharge, maybe something like amortization, which was not yet accounted for. So in our case, what we have is this amortization. Remember, S Limited didn't account for this revaluation of asset. It never accounted for this amount. It equally never accounted for this what? Amortization. So if this amortization was accounted for, automatically that one was supposed to be deducted in arriving at this what? Profit. So we deduct that amortization from that profit for the year. That will give us what? That will give us 1380. Is that the case? 1380. 1380. Are you getting 1380? 1380. I'm not getting answers today. I'm not getting answers. Karaja, I need to get answers. Peter, I need to get the answers. Once you get the answer, type it in the chat box. Type the answer in the chat box. Type the answer in the chat box. Yes. Now, in this case, we have said that this being the profit for the year, we translate it into presentation currency using the average exchange rate. The average exchange rate in our case is what? A6. A6. So we take 1380 divided by 6. 1380 divided by 6. Divided by 6. That will give us what? That will give us to 30. So then what we need to do, make sure you leave 2 lines here. And then we have the net asset, the crossing net asset, the crossing net assets. The crossing net asset will be this plus this, which will give us 4580. 4580. And actually this one should always reconcile. This one should always reconcile with the net asset of the subsidiary at the end of the year. Remember how we compute the net asset of a subsidiary. We said you can either take asset minus liabilities or equity. We said in group accounts, we compute the net asset as the share capital plus reserves. So if we go to the statement of financial position of this company, that is S, what is the value of its net assets, which should be the share capital plus reserves. So the net asset of S at the end of the year, which is the share capital plus the share capital plus reserves. Can you see that figure? I can see that as a figure of 41. Is that the figure? 41. The share capital plus reserves. Yes, you can see it's not reconciling with this. The reason being that there are a number of items which our company had not accounted for. This company revalued the asset, but never accounted for that. Remember, if S Limited had accounted for this amount of 600, this was supposed to be accounted for as a revaluation reserve. Being a revaluation reserve, it was supposed to be included here. The company was supposed to add 600, and then the profit for this is also part of this. Profit for this is part of this. So the company was supposed to deduct or to have accounted for this as an expense. Was it accounted for? No. So that 120 should be deducted from that value there. And if you work out that, it should give us this value there. It should give us that value. So the reason why those two figures are not reconciling this and this is because our company had not accounted for those two items. If you work out that, is it now reconciling? Is it reconciling? Yes, it is reconciling. Now, what we need to do then, we translate this into presentation currency using the closing exchange rate. Using the closing exchange rate, 580 divided by 4. That will give us 1145. 1145. 1145. So then what we need to do is basically we add these two values, which will give us 870. And then we compare this and this. We compare that with that. We determine, do we have an increase or a decrease? I can see we have an increase. An increase is an exchange gain. Is an exchange gain. Is an exchange gain, of which this one will be part of other comprehensive incomes. So which I'm told is 275. 275. Yes, in our case, we are done. We are basically done. That is what was required as far as that question says. That is part A of that question is concerned. By doing that, you get 6 marks. I want us then we move to part B of the question, which is very, very simple. Very, very simple. You'll be able to see that. Part B, what are we required to do? We are required to prepare the consolidated statement of a profit or loss, which is basically for the year which ended 31st of December 2021. 31st of December 2021. Now, how do we prepare this one? We prepare that by consolidating, by basically combining similar items of revenue and expenses, that of the parent, that of the subsidiary. But we have said before we do that, we have to translate items of revenue and expenses of this foreign subsidiary into Kenyan shillings. We have said to translate this, we always use the average exchange rate. The average exchange rate. So let's just do that translation here as we prepare this. So this would be in Kenyan shillings, and our figures are in million of shillings. So we go back to the statement of profit or loss for individual companies, which is given, I think, below paragraph 2 of our question. We take the revenue of the parent, which is 2145, plus the revenue of the subsidiary, which is S, that is 10,500. But because this one is in franc, we need to translate that into Kenyan shillings by dividing that with the average exchange rate. Dividing that with the average exchange rate. So the average exchange rate, as per the information we have in note number 6, is note number 5. The average exchange rate is 6. So do we have any adjustment here? No, because the only adjustment affecting revenue is intergroup trading. Do we have any amount of intergroup trading? No. So we just need to get the final value here. 10,500 divided by 6 plus 2145. I'm getting 38.95. 38.95. So then from there we check the cost of our sales. cost of sales, we do the same. We take that of the parent, 915, plus that of the foreign subsidiary, which is 63. We divide that with the average exchange rate, which is 6. Do we have any adjustment here? No, because we know that the only adjustment which is effected here is adjustment for ungauged profit, depreciation under charge, which we don't have. We don't have any of those adjustments. So just an issue of translating 63 divided by 6, 1050 plus 915. So which will give us 1965. So we let's start from the revenue. We get the gross profit. We get the gross profit. The gross profit. The gross profit would be how much? The gross profit. The gross profit, I'm getting, yes, I'm getting that in what? 90. So then from there we have the distribution cost. The distribution cost, in all questions for group account, we said these items do not have any adjustments. Just maybe translating the distribution current, and that is 3550. 35 is of financial position as at 31st of December 2021. 31st of December 2021. Yes. So how do we prepare this one? We prepare this basically by combining, by adding together similar items of assets and liabilities, that of P, that of S. But now, remember the assets and liabilities of the foreign subsidiary are in franc. We translate them into presentation currency using the crossing exchange rate. The crossing exchange rate. That is what is important here. So we will start with the non-current asset, and remember our figures here will be in Kenyan shillings. In Kenyan shillings here. So we start with the non-current assets. The non-current assets. So for the non-current assets, we have the PPE, property, plant, and equipment. So we will take that of the parent, which is 4850, plus that of the S Limited, which is 7,000. And then now we divide this with the crossing exchange rate. The crossing exchange rate as per note number 5 is 4. So no adjustment here because there was no item of PP which was revalued. So we just get the final value. So I'm getting what? I'm getting 66. I'm getting 66. Are you getting 66? Are you getting 66? Yes, 66. So down there, what we have is the investment in S. The investment in S is automatically the purchase consideration, which was paid by the parent company in acquiring shares of S. I hope you can be able to remember that amount. It was here, this one. It was 3550, but now this amount, this one is in franc. Automatically, this one was translated into Kenyan shillings at the date the purchase consideration was paid. The purchase consideration, this one was paid at the start. So this one was translated into Kenyan shillings using the opening exchange rate, which is 5. So if you divide that with 5, that will give you what? 710. So, but do we include that amount here? No, we don't include the purchase consideration paid in acquiring a subsidiary here. What we include instead, we include the goodwill. The goodwill on acquisition of S. And the goodwill on acquisition of S at the end of the year is basically what we have here. This goodwill, which has already been translated in Kenyan shillings. This one, 45. That one, Sasa? Yes. So the other item which you must also remember to include here, because we don't have any other non-current asset, remember the subsidiary revalued this brand. We can just include it here as unrecognized brand. So the brand was valued at an amount of 600, but it was supposed to be amortized with an amount of how much? 120. So we left 120. But now, remember these figures are in franc. That now will give us the unrecognized brand at the end of the year. So which will be 480. We need to translate that using the closing exchange rate. I hope you can see what I've done. 600 minus the impairment loss. That will give us 480, which will be the value for an unrecognized brand at the end of the year. But still in franc, we need to translate that using the closing exchange rate, which now will be 120, because it is 480 divided by 4, divided by 120. 120. So we move, and then we record the non-current asset. Sorry, the current asset, that is. I think we can do away with this one. Yes, so we record the current asset now. The current asset. So for the current asset, we have inventory. Inventory, we take that of the parent, which is 1030, plus that of S, which is basically 24. We divide this with 4. That will give us 600. That will give us 1630. We have trade receivables. Trade receivables, we take 970 plus 1960 divided by 4. Yes. So no adjustment here. You can see we don't have any adjustment. I'm told it's 1460. I'm told that is 1460 by Mercy. By Mercy, I hope that is correct. 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 Okay. So then from there we have the cash and cash equivalents. So we do the same. We take 4 for 10 plus 540 divided by 4. No adjustment still. No adjustment still. Yes, what are you getting? Yes. 545 like that. 545. Okay. So basically we are done with that. We said in this question, never bother yourself getting totals. What is marked are these. These are the entries which are marked. Never bother yourself getting totals. So then we move and basically we record what? We record equity. So we start with the ordinary share capital. So for the ordinary share capital, basically we know that we only include the share capital of the parent. The share capital of the parent, which is 15. So below that we have a share premium. Share premium. Share premium will also include that of the parent company only, which is 500. Below that, what do we have? We have the retained earnings. The retained earnings, we say no need of computing that. Just that one is just leave it. Don't bother yourself computing that. But now, in these questions, because we may come across a question maybe in the topic when covering cash flow, you see these particular exchange differences which you have recognized here. When we have those exchange differences, this one. So we compute the exchange difference, which is basically attributable to the parent company, and we recognize it here as a component of equity. Basically, we refer to that as currency translation reserve. Currency translation reserve. The currency translation reserve for the parent company. So to compute the currency translation difference for the parent, we basically get this total. This will give us a total of what? This will give us a total of 75 plus 275. That will give us what? Is it 350? Yes, and then we compute that of the parent company. That of the parent company will be equal to 80%. That one will be equal to 80% for the parent. That's that? Yes. For the parent, that which we include here. That's why you can see even share capital, share premium, we are including that of the parent. 80% of that will be 280. That one should be recognized there as a component of equity. So then in that case, automatically we can't be able to get the total. So equally below here, there is something else we compute. No need of equally computing this one. Then NCI, we just leave it. And then now from there, we proceed to record the liabilities. We record the liabilities. We start with the non-current liabilities. So for the non-current liabilities, we have 10% boards, 10% boards. I will take that of the parent, which is 820 plus 2640. But this one, remember, we translate items of asset and liabilities using the crossing. Items of asset and liabilities. The crossing is 4. The crossing is 4. That will give us what? 660 plus the 820. Yes, that will give us 14. That one will give us 1480. 1480. So then from there we have the deferred tax. The deferred tax. So the deferred tax will do the same, 740 plus 2160, divide that with 4, and then we get the final value here. What would be the final value? The final value. Is that what you're getting? Yes. So then next we have the current liabilities. The current liabilities. So for the current liabilities, we will start with the trade payables. We will start with the trade payables. So for the trade payables, we will take 1330 plus 2240. We divide that with 4, and then current tax. Current tax, we take 520 plus 760, divided that with 4. Divided that with 4. So that's basically how we get the final values there. So 1890, I presume that is payables. What about the current tax? What about the current tax? The current tax is what? Is 710. Is 7 what? 10. 710, 710, 710. So basically that would be the total equity and what? And liabilities. Total equity and liabilities. So no need of getting the total because there are 2 items you have not computed up there. And that question, if you do it like that, even if you have not computed the NCI, even if you have not computed the group retained earnings, basically that is the question will be able to score all the marks. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So 15 out of how many marks? Out of 8. So automatically take into account we have 8 marks, 15 ticks. So this how such a question is marked. For any 8 at 1, you just need to get 8 items correct. If you just get 8 items correct, you have all the 8 marks. You have all the 8 marks, all the 8 marks. And I think that should also apply here. Any 6 at 1, any 6 correct item, you get 1 mark each. By the end of the day, you get your what? Your 6 marks. Your 6 marks. So that is it. That's basically how we do the translation and also the consolidation. Can you see how simple this is? Yes, this is very, very simple. This is a question I think which has been repeated for a number of times. This question was examined some time back, but they decided to repeat it in this particular sitting here. There is a question I want to give as an assignment. I think the question for which sitting? Is this one for December 2023? You attempt this question December 2023. 2023, which is basically question number 1, you'll be able to see it's just the same. Although this question, there was an adjustment affecting I think payables, but just attempt it. Maybe during our revision, we will be able to see whether we will get some time and look on that question. Sasa, but that is it about regarding the foreign or the overseas subsidiary. It basically means that once now we meet next week, we are basically finalizing on this. We are finalizing on this because now what is remaining is on group cash flow, or basically the consolidated cash flow. That is what is remaining. But automatically we will be able to come back to this topic during our revision, because remember I said that this is a very serious area. If you check on the past papers, you'll be able to see mostly there are 2 questions which come from this topic. 2 questions. A question for group cash flow and another question for group account. Like the paper which was there last meeting, how many questions were there? I think last meeting I think there was just 1 question. There was just 1 question, which was very simple. Actually, that paper for last meeting, it was one of the easiest paper which has ever been tested. There was 1 question, but if you check on the other paper for, I think, December 2024, there were 2 questions. There was a question for group accounts, I think piecemeal acquisition, and there was a question on cash flow. There was a question on group cash flow. If you check on the paper for August 2024, there were still 2 questions, group cash flow and another question. So that's why I'm saying that these are very, very common area in the exam. Either you get 2 questions of 20 marks, or basically maybe 1 question. But mostly, I expect 2 questions this sitting, because you can see last time there was no question on cash flow. I expect that will be tested this time, and also another question for group account. Yes. So for today, we're going to stop at that point. Make sure you attempt that question for December 2023. Once we meet next week, we are finalizing on this, basically by looking on discussing what is the group cash flow, and then from there we will be able to see what is remaining, such that by 21st we should be done with this and we start officially our revision. So let's stop at that point for today. Have a nice weekend. See you next week on Tuesday.